Imagine a mother and her son spending a quiet Sunday afternoon in a library. As they wandered from aisle to aisle, the son paused, looked, and asked, Ma, why are different books placed on different shelves? She smiled and said that each book on these shelves started with a simple idea. An author started with first page and kept writing until it became first chapter. Then first chapter led to the second chapter, and second chapter led to the 10th chapter until one day it became a finished book. Then it found its way into the hands of readers. Some quietly found its audience. A few became timeless classics, and others quietly faded away. Over time, each book earns its place, and that's precisely why different books are placed on different shelves. But here is something different. Do you know that placement of stocks on a stock exchange works similarly? Every listed company has its own story. The entrepreneur identifies the opportunity, and the business takes shape through patience, perseverance, and purpose. Employees contribute, customers place their trust, investors provide capital that allows the business to grow. And year after year, decision after decision, chapter after chapter, the story continues. While some businesses remain local, others go on to become household names, but a select few make it to what I would call the great library of Indian businesses, or Indian Stock Exchange, where thousands of businesses make their placement through their years of innovation, resilience, and growth. Today, in Signal episode 33, let's walk through the great library of Indian businesses, because once you understand how this library is organized, you would understand why listed companies are classified by their market capitalization, and higher share price does not necessarily mean larger company. Welcome back to Signal, where noisy markets meet simple, sharp, and sound insights for long-term investors. Every great library has a history, and so does Indian Stock Exchange. So let's begin with 1980s, where our investment library was much smaller. Many of most recognized books belong to India's great industrial houses, companies like Tata Steel, Reliance Industries, Mahindra and Mahindra, Larsen and Toubro, ITC, Hindustan Lever. They were established, trusted, and household names. For most Indian families, investing was deeply personal. People predominantly invested because they trusted in the entrepreneur or founder. Information exchange was much more slower. Annual reports took months and months before they could be published and analyzed, while business newspapers were essential source of insight. Investment ideas were openly discussed and shared with friends, relatives, bank managers, trusted advisors. The premise of investment decision making was trust, faith, and conviction. The 1990s chapter changed India's economic story forever. Liberalization opened the country with new era of opportunities. Private enterprises accelerated, competition increased, Indian businesses started thinking globally, foreign institutional investors started participating in Indian capital markets. Along with capital, they brought global attention too. Suddenly, Indian businesses were not only competing domestically but also globally. An entire new shelf started appearing in our investment library. Financial services, information technology, modern pharmaceutical, private banking, infrastructure. The library was not only growing larger, it was also growing richer, more diverse, more ambitious. And with each new business, a new chapter was getting added in India's economic journey. If you are an investor in 2000s, you would remember physical share certificates. Owning shares meant holding beautifully printed share certificates. Each certificate represented ownership in real business. Buying shares required paperwork, forms, signatures, and patience. Those certificates were carefully stored in folders, cupboards, and family lockers. Then came digitalization and demat accounts. Transactions started becoming more simpler, faster, effective, and efficient. And in the meantime, Indian businesses started expanding globally. Technology companies served clients internationally. Manufacturers started reaching out international markets. Telecommunications connected millions of people. And our investment library continued adding new shelves, new authors, and remarkable new stories. The decade of 2010s not only transformed businesses, it transformed investors too. Smartphones, online investing, low-cost brokerage, and systematic investment plans. Millions of investors opened demat accounts for the first time. Investing was no longer restricted to a smaller group of participants. The door of the library was wider than ever before. Students, young professionals, families, retirees, everyone was now able to walk through those doors. The reading room became busier. The conversations grew richer. The library had become part of everyday India. And today in 2020s, the great library of Indian businesses consists of nearly 6,000 listed companies that represent a value of nearly 482 lakh crores or 5.6 trillion US dollars. It has indeed become one of the largest equity markets in the world. But perhaps the most exciting part of this story is that the final chapter has not yet been written. In 20, 30, and perhaps 50 years from now, the library would look completely different because each generation produces new set of entrepreneurs. Each generation solves different problems. Each generation writes new business stories. Some of today's emerging businesses would become tomorrow's classics, just how Infosys, Reliance, HDFC Bank once represented the future. Now this brings us to an interesting question. If the library consists of nearly 6,000 listed companies, then how does a company earn its place on a particular shelf? The answer is surprisingly simple. The businesses are organized according to their size. In India, under SEBI's mutual fund categorization framework, AMFI classifies companies into three broad groups based on their market capitalization. The largest 100 companies occupy large cap shelf. Companies between 101 to 250 occupy mid cap shelf, and everything beyond 251 belongs to small cap shelf. As a company grows or shrinks, it moves between the shelves. This placement is reviewed every 6 months. So if a mid cap business continues to expand, it gets promoted to large cap shelf. If a large cap company shrinks, then it will need to move to mid cap shelf. And same applies for mid-cap and small-cap companies. So this brings us to market capitalization. Market capitalization is simply the current market value of the entire business. It is not based on company's age, number of employees, or annual revenue. Instead, it is calculated by using a very simple formula. Market capitalization equals to share price times outstanding shares. Share price is simply the most recently listed or traded price on the exchange. Outstanding shares represent all the shares issued by a company and currently owned by its shareholders. These shareholders include founders, promoters, employees, mutual fund companies, insurance companies, foreign investors, and individual investors like you and me. For instance, today, as of 11th July 2026, Reliance Industries has about 1,353 crore outstanding shares, with each share valued at about 1,300 rupees. The market values the entire business to be around 17.7 lakh crore or 186 billion US dollars. That places Reliance Industries among India's largest listed companies or large cap. Now let's compare this with Asian Paints. Asian Paints' current share price is about 2,700 rupees, more than twice the price of Reliance Industries. But Asian Paints only has about 96 crore outstanding shares, so that takes its market capitalization to about 2.6 lakh crore or 27 billion US dollars. Asian Paints is also a large cap company, but its market capitalization is only 1/7 of Reliance Industries. So, what does this tell us? This tells us that higher price does not automatically mean that the company is larger. And this is one of the biggest misconceptions in investing. As stated earlier, a higher price does not automatically mean that the business is larger. It may simply be a reflective of factors like fewer outstanding shares. A share price reflects the value of one share, whereas market capitalization tells us the value of entire business. And that's precisely why experienced investors judge a company by its market capitalization rather than share price. Large cap, as the name suggests, represents largest companies that have already achieved significant scale. Companies like Reliance, TCS, HDFC Bank, ICICI Bank, Infosys have spent decades in creating substantial shareholder value. The mid-cap represents businesses that have moved beyond their early years and are entering their next phase of growth. Many of these companies continue to expand in new markets by introducing new products and strengthening their competitive position. At the time of recording, companies like Bharat Forge, Cochin Shipyard, Persistent Systems, PB Fintech are good examples of businesses in this category. Many of tomorrow's large cap companies are likely sitting in today's mid cap shelf. The small cap shelf represents the broadest universe of listed businesses that include specialized manufacturers, innovative technology companies, regional champions, and businesses that are still building scale. At the time of recording, companies like Kirloskar Oil Engines, Data Patterns, NetWeb Technologies are good examples of companies within this category. Some of these businesses will remain successful specialists. Few of them will grow into mid caps and perhaps will make a way into large caps too. It needs to be noted that each category reflects only business's current size, not its quality or future returns. The next question isn't about companies, it's about us. Which category is right for our own investment journey? To answer this, let's walk back into our library. Each reader walks in with different expectations. Some may prefer timeless classics. Some may prefer emerging authors, while others may prefer a mix of books from various shelves. Investors are no different. Each investor has different financial goals, different circumstances, different investment horizons, different responsibilities, different risk appetite. And that's precisely why there are various alternative solutions available: large cap, mid cap, small cap, multi cap, flexi cap, manager of manager, fund of fund, and the list goes on, and each have different investment approach. So the question here is not which category is the best, but the real question is which category is right for me in my circumstances. And here is where a professional advice can help. A SEBI registered investment advisor can carefully calibrate an investment strategy by understanding your unique circumstances and advising the right category that is appropriate in your situation. Perhaps the most valuable lesson from today's story was not about books at all. It was about businesses. Just as each book earns its place on a library shelf, each business earns its place in the market. Some businesses grow into large caps, and some continue writing their story as mid caps and small caps. So the next time when you hear large, mid and small cap, simply remember that it's referencing the size of business at that point in time. Now that brings us to the close of today's episode. I'm looking forward to seeing you inside the great library of Indian businesses.